Yeah, so let us start with the book 5 chapter. Yeah, so book 5 chapters are institutional investors and the trading performance evaluation and case studies. So let us go briefly through each of this. So we'll first cover the institutional investors. So at a macro level, what are the institutional investors? What are some common characteristics? There are some which are listed over here. So I'll just use a good marker so that we're able to track it. Yeah. So obviously, institutional investors have a large scale, investments. They are not like retail investors who are investing, few 100,000 or even millions into the market. They are like really large institutes, and so one of the great factors and in the IPS becomes their large investment size and the corpus that they hold. Their horizon is generally long term because these funds or these institutes they manage the money for a cause or for a target. So these generally in the shorter term you can't make really good money in the market, so obviously the horizon is long term. From a regulatory perspective, they are governed by the government bodies. So it's not like a retail investors. They are supposed to file their regulatory investments, notify the regulators about their position of their liquidity and all those things. So depending on the country which the institution is working at, the local regulatory becomes important. They have a formal governance structure in place. When we say governance structure, is basically they'll have internal auditors, external auditors. Mainly the entire framework will be from a company's ethics point of view. An ethics framework will be there, an operational framework will be there, a risk framework will be there. So there's a formal governance framework. Then in these institutes, you will usually see a principal agent issue. We have seen this a lot of times. The principal agent issues, wherein the person who is managing the money might not be in sync with the person who is sponsoring that fund or that portfolio. This usually happens in the institutes wherein the funds are outsourced to other fund managers or portfolio managers to manage the entire corpus. So these are some important characteristics. Important from an AM perspective, in the afternoon chapters, in the afternoon this becomes very important. So this becomes important from an AM section also. Okay, so there are some investment policy statement pointers that we need to remember from a institutional investors point of view. So again, we have seen this IPS, know, pillar of IPS so many times. So these are some pointers like what is the objective for the investments. So what is the risk and return tolerance? Then what is the horizon and what is the current liabilities? Because you might have a institutional investors who is investing the money to manage their liabilities, like pension fund, defined benefit pension funds. They do the investments to manage the future liabilities. So what is the horizon and what are the current liabilities? Are there any external constraints? Like is there any regulatory this thing or any investment committee or any shareholder blockade for investments? So those constraints. What is the current strategic asset allocation and rebalancing policy? So obviously any institutional investor will have an allocation policy or a strategic asset allocation or the ideal asset allocation that they want to have, and based on that they might also have a rebalancing policy in case the threshold reaches or the market situation changes, they might want to rebalance. And what are the reporting requirements is basically from a regulatory perspective or from an investment presentation perspective, what are the reporting requirements. So there are four asset allocation models that are mentioned uh, in the chapter. First one is the Norway sovereign wealth model. Second is the Yale University endowment model. Third is the Canada pension model. Fourth is the liability driven model. So Norway sovereign wealth model is basically passive investments. So the advantage is it's a passive investment. Since it's a passive investment, the fees is low and the allocation is generally 60 equity and 40% in debt. So Norway sovereign wealth model is one of the asset allocation model. And one of the advantages of this is it's a passive model, easy to manage. It has obviously no asset allocation to alternatives. The ideal allocation is equity 60%, debt 40%. Since it's passive, it will have a very low fees because there is no active management or a manager involved. And once it's a passive fund, you know that you cannot outperform the market because you are tracking the index or you are doing a defensive allocation to your fund. So the disadvantage is there is no outperformance. Second is the Yale University endowment. Sometimes in the question they mention Yale, sometimes in the question they mention university. So both of them mean the same thing, the Yale University endowment. They have high allocation to alternative investments. They are outsourced to external fund managers, so external asset managers. External asset managers are hired, and obviously, since they are investing in alternatives, they will have an advantage of outperforming the benchmark. One of the disadvantage of having alternative investments is basically it is limited to large investors. Obviously, we know that private equity, alternative investments, real estate investments, and private debt for that matter are only available to qualified institutional investors. And this is high fees. We know from all the levels of CFA that 2% and 20%, 2% management fee, 20% outperformance fee is generally the fee structure for alternative investments. Third is the Canada pension model. Okay, this is again high allocation to alternative investments, same outperformance. It is similar to the Yale University. The only difference is you have qualified fund managers to manage your assets internally. So it's the asset management is done internally, and since it is done internally, you need to hire such skilled people, and you need to retain those people, and you need a team which you can actually manage your internal assets well, so as to invest in complex instruments like alternative investments and still have an outperformance. So this is a high fees and expensive affair. The fourth one is we have done is in fixed income, it's a liability driven model, wherein we the focus is on the surplus optimization. After funding all your liabilities, whatever assets is left, only that is looked at optimization, considers liability. All these other three models are asset based model. This is the liability based model. Disadvantages, obviously long term liabilities are difficult to hedge. The reason is basically, once you have a long term liability in your books, there are several factors which can impact the value that the liability will have in future, so it's generally difficult to manage. Right, the interest rate could change, there could be prepayments, there could be repayments, you could be withdrawing, getting more liabilities in that saying back factor, or the pension funds rates have gone up. Anything can happen in long term liabilities. Okay, so the first institute that we are going to first read about, what are the features, what are the benefits, and what is the uh, overall objectives, is the pension funds. So under the pension funds, the objectives, horizon, liabilities, external constraints, and all these things are discussed here. So who are the stakeholders? Obviously, there are two pension fund. One is the DB plan, one is the DC plan. We know that in the DB plan, you get a fixed and a confirmed amount on your retirement every month, or say every quarterly or every yearly, depends on what the annuity is. And in the DC, this is for DB plan, the liability is known and the risk is with the fund sponsor. In the DC plan, you contribute to the fund, but the risk is with the investor. Risk is with the investor, and the amount may not be known, but the amount is basically not a matter for the sponsor because it's a defined contribution. The sponsor or the employer is not taking any liability of funding this thing or giving you a guarantee that this amount will be given to you after retirement. But in the defined benefit, it's defined benefit. This is defined contribution. So whatever contribution you're doing, that is defined. The benefit is depending on the market forces, whatever market will do to the portfolio. Defined benefit, wherein your outflow or the income that you're going to get at your retirement is defined. So this is the basic difference. We know this from all the levels of CFA. So the stakeholders, obviously employers, investment staff, government, shareholders, pretty straightforward. Okay, this is very important. This comes across all your AM questions. So when will the liability increase? For a fixed income, sorry, for a fixed plan where the employer has to bear the risk. If the employees work longer, obviously, longer the employer works, more outflow it will happen on retirement. If the base value of the salary is higher, They live longer because you have to give the retirement money till they are alive. Lower employment turnover leads to higher vesting. So employees should, there should be a healthy turnover of employees also. It should not be that your employees are not leaving your company, otherwise your liability will be very high. And the discount rate is low. We know that present value of liabilities is basically sum of all your liabilities in future discounted at a discount rate, right? If the discount rate goes low, the denominator goes low. Once the denominator goes low, the numerator increases. Numerator is your present value of liability. So if the discount rate is low, like nowadays the interest rates are very low. So your liabilities present value will increase because you are discounting it at a very lower rate. So this is one of the liabilities. In the DC plan, no such liability we discussed. To the plan strategy, only the contribution, the person who's making the contribution, employees like me and you, are at risk, though they have the liability. Investment time always longer, depending on the age of the participant, longer if younger, but it's generally longer. For the exam, just remember it's longer. Liquidity needs are higher when there are more retirees in your portfolio. So if say you have a government company like say the Indian government company ONGC, or no, it has around so many employees, or Indian oil company, so many employees who are retiring this year. So a defined benefit plan will give them a long list of retirees, and the liabilities will go up. Older workforce, obviously, because older workforce is likely to retire sooner. Flexibility of participants to switch plans. Now this is very important. If there is an option for the participants to switch plans, then your liquidity needs will be higher, right? If the participants switch plan, then you'll have to redeem the portion of the fund and give it back to the employer. This is again same. So basic difference will not be there in liquidity, investment horizon, and all those things. The major difference is only between the liabilities and the sponsorship. External constraints, it's regulated by IORP in Europe and ERISA in United States. Same. Tax treatment is favorable. Obviously, it's a very long-term investment. Plans are tax deferred. Here, the tax treatment is favorable. Quite self-explanatory. Investment objectives: long-term investment to fund long-term liabilities with an appropriate risk to meet contractual liabilities. Simple. We understood that the DB will have long-term liabilities because they have fixed liabilities. Here, the agenda is to beat the inflation, right? Because here the risk is with the person who is contributing the money. So the fund which is managing this money will primarily target returns which are greater than inflation, at least greater than inflation, so that at least the risk-free rate, or the real risk-free rate plus the inflation, some returns are provided to the DC plan holder. So we saw the pension fund. In nutshell, the pension fund is long term. The liquidity needs are high when the workforce is older, or there are plans to flexibility to switch plans, and so on and so forth. Generally, the horizon is longer, and the liability lies with the employer in DC plan and with the employee in the DC plan. The second entity that we are going to see is basically the sovereign wealth funds. So when we say sovereign, is basically the countries, sponsored by the country, and obviously the tax-paying citizens. So the stakeholders are obviously country citizens, the government, external and internal investment managers. This is very important from a understanding perspective, that a lot of time SWFs are very complex. In case when you try to learn about it outside the CFA, this thing. So over here they have tried to just make it a very simple kind of a thing. So over here, let's see what are the types of funds, that is budget stabilization, development, savings, reserve, pension reserve. If you learn it from the book, it's quite simple. I'll just explain you in nutshell. So the budget stabilization funds are those funds wherein the basically the it's for those countries which are natural resource heavy. Okay, and the like OPEC countries, Saudi Arabia, UAE, those countries have budget stabilization fund, wherein their country is very much dependent on a commodity price. Then development funds are for again third world countries, maybe like Africa, some countries in Asia. So wherein the development is required either in the agriculture structure, or agricultural field, or in the education field. So that All those funds come under the development funds. Then is a savings fund. Again, the funds over here, the funds which are getting money in the savings funds category, they try to invest in savings. What the savings means, when you save it for the future. So savings funds is basically those funds which are investing in the renewable, or the you know the clean energy, or renewable assets, or renewable technology. Okay. Okay, so the reserve portfolio is, obviously we have always heard of this term reserve with central banks. So we say Reserve Bank of India, Reserve Bank of US, Reserve Bank of Switzerland, and so on and so forth. So these are the funds which are managed by the central banks. And pension reserve is basically like central banks have the reserve for the country's liability. Pension reserve is basically an outsourced arm of the government. So government will manage what? Government will manage fiscal policy, monetary policy. The government also has liabilities in terms of pension, because the government has to pay the pension, right? Now, government cannot manage the pension funds in by themselves. What they did, they outsource it to a pension fund house appointed by the government. In India, there are a lot of pension fund managers. Like I think so, Reliance is one of them. Reliance, and I think so, BlackRock was one. I don't remember, but yeah. So government will announce a pension fund manager to manage the funds for funding the future liabilities of the government. Okay, so let us understand this table in a nutshell. So, what are the liability structure? Budget stabilization is obviously linked to the commodity price. We discussed that it's linked to a commodity thing. Liabilities is again in development related to socio-economic investments. Over we can do it for land, we can do it for agriculture, we can do it for education, depending on what is the motive. Savings fund, obviously they are investing in the future technologies, so it depends on how much money and how much investment is required over there. Reserve is yield promised on central bank government bonds. Obviously, when the central bank, what is the role of a central bank? To pump in liquidity and suck the liquidity from the market by doing the borrowing and lending. So when they are borrowing, they are promising a yield to the investor. So what is their liabilities? Liability is the yield. That's what they are saying. Yield promised on central bank government bonds. And liabilities for pension, we all know what are the future pension outflow. So over here, if you see, it's very simple. Except the budget stabilization, which is short term, everything will be long term. It is very simple also to understand. Central banks' pension and savings will never have a short term vision, because they obviously want to have a lower volatility portfolio. The budget stabilization cannot have a long term portfolio because it is related to commodity, and commodity is cyclical. So you might have a cycle wherein the crude is running high, and recently the crude went negative, then the crude can go really high. So it's cyclical. So you need to adjust tactically. That is why a short term investment horizon. When the investment horizon is short, the liquidity will be highest, and so on and so forth. Lower for as the investment horizon increases, the liquidity decreases. So horizon increases, liquidity decreases. The liquidity need decreases. External constraints. This is again not relevant so much for the exam as such. They are generally tax beneficial accounts, funds. Investment objectives is important. Budget stabilization is basically capital preservation. Again, I told you that it is linked to the commodity prices. Commodity can be very volatile, so it's important to preserve the capital. Development fund is basically growth higher than the real GDP growth, obviously, because they want to invest in the emerging markets or third world countries where a lot of development is required. So they need the money to grow really fast. So these entities, they generally don't park their money in developed countries, because developed countries yield and returns are very low. So these countries, they hire external asset managers to have a mix of the global assets. Savings maintain perpetual spending. This is somewhat a controversial statement. You cannot never have a perpetual spending as such, but it's okay for the education perspective. Reserve is basically, obviously, how much yield you have promised to the investor. You should be earning more than that. And pension, we know that if your liability is, say, suppose 100 million, so at least 100 million is the objective to return, because you need to fund your liabilities. You can never go underfunded. If you go underfunded, you'll have to either borrow or sell your assets. So this is more from a SWF, sovereign wealth funds. The next is very important, wherein you talk about the actual where the most of the money is lying across the world, which is the banks and the insurance. So banks and insurance are very important over here. Who are the stakeholders? Obviously, the people who are giving money to the bank. People who are giving money to the bank are depositors. People who are taking money from the bank are the creditors, borrowers, and the other agencies which the bank is dealing with. Internal and external, employees or outsourced employees, boards. Same here. Liabilities are deposits. Obviously, the money that you keep in the bank is a liability for the bank. That is why they pay you interest. For the life insurance, what will be the liability? It's simple. For the life insurance, the liability will be the payout on death or whatever is the endowment, whatever is the plan. For property and casualty is basically the mortality the rate of accidents, the rate of fire, and all those things. So this is a PNC. So long life insurance will usually have a longer duration. People don't based on the mortality table. So we have studied the mortality table. Based on the average lifespan, the horizon will be longer. But PNC insurance will have a shorter horizon because there is a lot of chances of accidents, fires, and so on and so forth. Robbery, so on and so forth. So PNC will have shorter horizon, shorter loyalties. Investment time horizon, obviously for the banks, it will be a mix of both, but this is usually LDI based. What is LDI? It's liability driven investing. Both banks and insurance have to pay amount back to the people who are depositing money with them. So they are always concerned with the funding of their liability. So once the liability is funded, so assets are provided for liabilities. The remaining part is the surplus investments. That surplus optimization is our goal. So any external constraints, obviously standard accounting constraints, capital provision, manage liquidity risk is their investment objectives. We discussed assets should be available to fund the liability. And with the amount which is say pending, say example, let's take an example. Say JP Morgan Bank. JP Morgan Bank has an investment book of say, so let's say JP Morgan Bank has an investment book of example $100 million, and they have a liability deposits. The people who have deposited with them as 150. So in their ALM mismatch, what will they see that they have only 100 million assets to fund 150 of liabilities. So the remaining 50 has to be funded by their own money, which is their equity. So asset plus equity is equal to liability, or asset minus liability is equal to equity, right? Asset minus liability is equal to equity. So the 100 assets that they have to fund 150, the 50 should come from the equity, so that the balance will happen. So they either have to raise money or do investments. So anytime they will always try to keep this amount as positive asset minus liability, which is mentioned over here. If you see, manage liquidity and risk mismatches between the institutions, non-investment assets and liabilities. This needs to be done in the context of institutions' overall profit maximization objective. So the agenda is to manage the assets in context with the liability. So over here we have seen some formulas over here, but it's not really complicated. In the book it's given a little extended version, but it's really not that complicated. So let us see that here they are mentioning what is the how do you measure the change in equity of a bank, right? So we discussed in the previous slide what is the asset is 100, the liability is 150. Then how do you mention the measure the change in equity? This is basically balance sheet management. See, for a bank it is very important that they manage their assets and liabilities well, because banks cannot go and raise money from the institutional uh, investors every day. So the only cheapest source of fund for them is the depositor who are depositing the money in the bank, because you're depositing and what you're getting 4% interest rate example, and this 4% is being lent out by the bank at say 8%, say home loan, and 12% personal loan. So what is the net interest income? Net interest income is How much they are getting it? How much they are paying you back? 4%. So directly 4% is their income for doing nothing, giving your money back to you. They are taking that commission. Okay, that's how banks run. So important for them is to always manage their assets and liabilities so that they don't have to fund it themselves. So it's important for them to measure their change in equity. So change in equity will be obviously change in assets minus change in liability. We know that equity is equal to asset minus liability from a simple balance sheet equation. So obviously change in equity will be change in assets minus change in liability. We have an extra term over here which is M. M is the leverage multiplier, asset upon equity. We know that leverage is basically how much asset you have against how much your own money you have. Okay, so this is a leverage multiplier. This is the only term which is extra. Otherwise, the formula is pretty simple from a balance sheet equation. Equity is equal to asset minus liability. You just slightly modify this formula, you will get the sensitivity of yield or returns to the duration of the equity. So in terms of yield changes, the future expected yield changes, you want to know how much equity you will have to, you know, put in or how much borrowing that you'll have to do. You can simply modify the changes, and the duration of the equity will be duration of the assets, duration of the liabilities. Just the extra term over here is multiplied by the change in change in the yield of liabilities related to change in the yield of assets. Okay, so I over here is for liabilities and A is for assets. So we discussed that earlier. The bank is giving you 4% interest, right? So the change in I will happen. Suppose this 4% becomes 5%. Example. So there is a gain of 1%. So liability is going up by 1%. And suppose the investments that the bank had done, the asset side, with the loan portfolio, though they were getting 8% over there, but there was high NPAs over there. And the returns came after NPA adjustment and everything, the return comes to only 2%. Now from 4%, 8 minus 4, the returns have come to 1% because the change has been on the negative side. So what happens? Your assets are growing at a lower rate than your liabilities because you have some non-performing assets. So this becomes important. Basically, your borrowing and lending should follow an interest curve which is better for you. So your borrowing curve should always be lower, asset curve should always be higher. So you'll have better net interest income margin. Expected change in volatility, we have studied this formula. If you look at it, closely, SD over here is standard deviation. I should have used the symbol. So we know this from the variance formula, portfolio variance. It is basically standard deviation of the assets, standard deviation of the liability. Again, the M term is coming from that top one. Just take it as it is, M and M minus 1. So it's asset square plus liability square minus 2 times standard deviation of assets, standard deviation of liability, square because it's variance, into correlation of asset and liability. If you just remove the M terms, this looks like a portfolio variance formula. Quite simple in that sense. The crux over here is basically we are trying to identify what will happen to the bank's own money or own equity in case the assets and liabilities change at a different rate or change at a different magnitude. Then what will happen? So this is important because the banks might run out of assets to fund their liabilities. See what happened in 2008 crisis. This was not done. This was done, but they knew they are running out of the tarmac. Okay, so their investments were, suppose example, $250 billion. Example, this was their asset size, and $300 billion might be their liabilities. So this was still manageable. 50 billion is nothing for, say example, the crash happened for Lehman Brothers. So Lehman Brothers, 50 billion is nothing in US in terms of the gap in asset liability. But what happened? This 250 billion assets that they were holding, the mortgage assets that they were holding, that went so low that no one was ready to fund them. So the value of the mortgage that they were holding, or the bonds that they were holding, or the CDSs that they were holding, were so low that no one came to fund them. Okay, so that is why after 2008 2009, the Basel regulations has added the amount that you need to put as collateral or risk money in terms of your equity. the tier 1 and tier 2 capital ratio. Okay, we resume with the second chapter, which is trading and performance evaluation. Over here, we are trying to understand whenever you are doing a trading or any fund manager is doing the trading, what are the motivations for the trading, what are the trading strategy which goes as an input, what indications the trader gets of trading in that market, how they envisage what to trade, and secondly, we'll see what is the cost. So, what are the motivations? Obviously, profit seeking is one of their motivation, increasing the alpha, reduce the alpha decay. Alpha decay is basically suppose you are planning to buy Reliance at 100, say 2100, and that is your decision making price, but you end up putting the order at say 2110, a 10 rupee or a $10 difference. So that is your alpha decay. So alpha is basically the time that you lose on making the actual investments, and reduce the info leakage. So dark pools is basically those suppose you want to invest into a big chunk of your money into a certain security. So dark pools are those the exchange is a lit pool wherein everyone can see your orders. Dark pools are certain executing platforms wherein the transparency is low and people will not come to know who is buying and who is selling. They'll come to know, but at a later stage, not at the time when you are doing the actual transaction. So the price sensitivity and the price information is reduced. The leakage is reduced. The other motivation is obviously whenever you're doing an investment, the primary thing that you have to do is risk management. Third is basically cash management, depends on the investments that you have to make and depending on the entity. So in case it's an entity which requires short-term liquidity, so they will not invest in those funds which can lose values, or those investments which can lose value. So it depends on the fund's liquidity. Also, you know that in mutual funds you can do SIP, you can also do removal of your funds. So subscription and redemption, how much money is being requested by the investors and how much money is being pooled in by the investors, that will differ. That will make the fund manager defer their investments and will force them to plan investments because they are sitting on cash. Excess liquidity equitization, there's a term which has been mentioned in the book. Excess liquidity is basically in case your fund is receiving a lot of subscription, then what do you do of that cash in case your fund is getting a lot of inputs inflows, but the market is not favorable. So what you do is basically you invest those kind of money into some short term ETFs or short term liquid funds, so that the cash drag is lower and your investments is not lying in cash, they are invested in the market but in a safer investment like ETFs or short term highly liquid funds. Another motivation which is not driven by you but driven by the market is the corporate actions. So any stock which is giving dividend or any leverage buy that you have done and there is a margin call by the exchange, or the rebalancing has happened. Suppose the Nifty gets rebalanced and say, suppose a stock goes out of the index and the new stock has been introduced into the index. So to adhere to the index, you might have to do the transactions. Any global policy or local policy changes. So these are the external factors. What are the inputs that goes as a trading strategy? Obviously, buy or sell side, absolute size, which is a large trade or a small trade, relative size, which is percentage of the average trading volume. So you might take a call that okay, I want to put an order which is 10% of the average trading volume of last 5 days. So that will be a relative order. And if you want to put an order of say $1 million, that will be an absolute order. It also depends on the security category, whether it's an equity, ETF, American depository receipts, global depository receipts, so on and so forth. Even FX transactions like currency pairs. Important strategies, important characteristics over here, the short-term alpha. Short-term alpha is basically wherein you are seeking intraday trading or say 1 or 2 day trading. So these are high urgency trades. In high urgency trades, what happens? The volatility increases the execution risk. Obviously, if a stock is moving very volatility, the exchange, the risk with the buyer is that the price at which the stock gets executed might be higher than the planned price. Market conditions is obviously the same thing that we have discussed over here. If the market is having high volatility, the execution risk is high. The market is having high liquidity, the execution risk is low. Risk profile, it depends on the individual investors or the institutional investors nature of investments. So if a short term insurance, property and casual investor, casualty insurance person or a institution is investing, they will invest in a slightly risk free investments or a lower risk investment because they have short term liquidity. So it depends on the risk profile of the institutions. What are the trading algorithms? High touch, so bulk trades, OTC, broker enabled, agency based trades. So these trades are basically, suppose I want to buy, say Rakesh Junjunwala wants to buy 0.5% of, example, Steel Authority of India. What he will do, he will not go in the market and trade now because the price might move ahead because 0.5% of any company is very big. So he will connect with brokers to have a bulk trade over the counter, or he will arrange these trades buying it directly from the promoters also. So those kinds of high touch, wherein the execution is not done manually, not done electronically, but done manually over the phone, planned, and it's not visible to everyone. It only it's visible after it happens, and the quantity which is being bought and sold is pre-planned, and it's done via a broker. So the broker will find a seller who is ready to sell that much of amount, and the buyer will get connected with the broker, and that exchange will execute this as a bulk trade. Electronic trading is what you and me both do. It's a direct market access while trading on the exchange directly via trading apps and algo trading. Then, what are the execution algorithms? These are the trading algorithms. How the exchange executes the algorithm, executes a trade. Scheduled algo, which is a percentage of volume. One of the advantages improved execution and disadvantage traders trade at higher price. Say I want to do a trading with say 15% of the trading volume. Right now, I'm telling only about the trading volume. I'm not telling about the price. So the risk that I have is I might execute my trades at a very high price because the condition is 15% of say trading volume. So it will only consider the volume, will not consider the price. So one disadvantage is that you will trade it at a higher price. Other are basically volume weighted average price and time weighted average price. So time weighted average price, volume weighted average price will have a benefit, but time weighted average price will have a disadvantage. There could be two disadvantages because since it's based on time and not on liquidity, you might be forced to trade in low liquidity and avoid the trade in high liquidity because it is not considering the volume. Volume over here it means liquidity, how much shares are available for buying and selling. Since it's time weighted, not volume weighted, that's why you might be forced to trade in low liquidity and avoid trade in high liquidity. Then another execution algorithm is the liquidity based algorithm, buying during maximum liquidity and selling during the lowest liquidity, so you get the highest spread. And over here, the arrival price is basically to based on the fundamental that you need to reduce your delay or the alpha decay. And one way of doing that is basically using algorithmic trading. Then dark is the discussion that we did on the last slide, the dark pools, wherein the execution happens in multiple locations and in non-transparent exchange platforms, wherein the information is not leaked to the market. And smart order routing is the last option, wherein the suppose you want to buy trades for a global asset which is trading in multiple exchanges. What you do is basically you put an order in a global with a global broker, but you tell him that I want to invest and trade only in those execution platforms where there are better liquidity and the price is better, the spread is less, and it could be a combination of both lit and dark. Lit means the exchange trading platform. Dark pools is what we discussed earlier, non-transparent trading platforms. This is important, how much cost you are incurring to invest. So suppose I want to buy a stock and I have a price in mind as to what price I want to buy, and I go in the market and execute that trade. but I'm not sure that I'm going to get the same price, right? So what is the shortfall? That shortfall is known as the implementation shortfall. It is basically the paper return. So suppose you wanted to buy a stock at say $10. So this is your thought price, and you want to execute. You went to execute this, and the stock price moved to $12, and the stock closed at $14. So your return for the paper return would be 14 minus 10 will be say 40% return, but your actual return will be 14 minus 12, might be around some 20 or 10%, 10-15% return. So this 40 minus 15 becomes your implementation shortfall, wherein the paper return minus actual return is your shortfall. We'll see it with an example over here, which is mentioned in the book also, but I've just summarized over here. Suppose you want to buy a stock for $20 at and for a quantity of 50,000. When you are placing the order, the price is 20.10. That is the arrival price, and actually the order gets executed at 20.34, because suppose this was a limit order, and on that day the stock closed at 20.55. You had put for 50,000, but the execution happened only for 40,000 because it was a limit order and the price moved above your limit order. So 10,000 quantity was not traded, and $0.02 was a fees that the broker has charged for executing this. So what is the execution cost? Execution cost is simply the arrival price minus the thought price, arrival minus the decision price. And what is the actual trading cost? Is the actual execution price minus the arrival price. So this is your execution cost. What is the opportunity cost? You had decided at $20 and the stock closed at 20.55, and around 10,000 stocks were not traded. You had ordered for 50,000 and only 40,000 got executed. So the orders which are not executed is the cost that you have lost, is the profit that you have lost. So this is your opportunity cost. Fixed fees is simply the dollar amount into the quantity executed. So what is the total implementation shortfall? It is 4,000, which is coming from the delay cost, 9,600, which is coming from the trading cost, and 5,500, which is coming from the opportunity cost and the fees. It is the 19,900. In BIPs, it's basically the cost divided by the actual investment amount. In the question, it could also be mentioned in BIPs. So this is the formula that you have to use. So we'll do this again just to for the revision. $20 is the price that you plan to invest, but when you put the order, the price is moving at 20.10, so that becomes a arrival price, and the actual execution happens at 20.34. Stock closes at 20.55, and it is broken down into three costs. One is the first is the execution cost, second is the opportunity cost, third is the fixed cost. So you can remember it like this: EOF, say end of file or end of something like that. Execution cost, opportunity cost, and the fixed cost. Fixed cost is very simple. This is the brokerage. Opportunity cost is the order not executed. Execution cost will have two components. One is the delay cost, one is the trading cost. Delay cost is based on the arrival price, trading cost is based on the actual price. And the sum of all these will become your implementation shortfall. Another way to really get this in BPS is basically this formula: the price at which you have executed minus the price at which you thought you will execute divided by the same price. It's very simple. The second is this is the trading cost. This is the market adjusted cost. The market adjusted cost is basically due to the movement of the market, the systematic risk, right? That is why we have beta over here, the systematic risk. It is the arrival cost, basically the cost at which you had planned your investment, the at the cost which is the price which is going on at the time of your investment, minus the beta of the index cost. And index cost has this formula, which is again based on the VWAP price. Now, I'm not going into detail in this. This is really very simple. It's given in the book. I won't suggest that you go deep into this. Just remember that there are four prices that are involved in any trading. One is the execution cost, opportunity cost, and fixed cost. Three end of file as a short form. And the execution cost has two part: delay and trading cost. Trading cost can be derived at with this formula. Basically, your actual price minus the price at which you will thought you will execute. So this is the shortfall. And market adjusted cost is basically because of the systematic risk of the portfolio. We then move to the performance evaluation. Maybe I'll cover this in another video. This video will be too long. So yeah, thank you.